Hello dear viewers, welcome to our video on Chapter 2, Theory Base of Accounting Class 11. Today in this video, we will be studying topics such as generally accepted accounting principles and few of the basic accounting concepts. To understand about what is generally accepted accounting principles, first let us break down the terms and understand what is accounting principles. In our previous chapter, we have studied that accounting principles. Accounting is the language of business. It communicates the financial position, the overall business activities to various internal and external uses of accounting information. We also studied that financial statements must be presented in such a manner that it is reliable, comparable, and understandable by all the users of information. Now the question is how this is achieved. This is possible only if the information is in the financial statement is based upon some rules, policies and practices. So here accounting principles is nothing but such rules based on which accounting of a business entity is prepared. So it is the set of rules, norms which defines the way that account should be prepared to maintain the uniformity is known as accounting principles. In simple words, accounting principle is nothing but rules based on which account of an entity is prepared, and these rules are universally accepted, followed universally by all the accountants while recording the transactions. Now, let us understand what is the need of following this accounting principle, necessities of following this accounting principles. This by following such principles, preparing our accounts based on some rules and standards helps us to achieve uniformity. So accounting information is better understood when it is prepared based on accounting principles. We achieve uniformity and consistency, and it is followed by all the entities while preparing their final accounts, and it also makes the information more meaningful to all the users of accounting information, and which is prepared by following generally accepted accounting principles. Now, as we studied what are accounting principles, we understood that they are nothing but some rules on which accounting of a business is prepared. Now, what is generally accepted? Generally accepted is nothing but which are globally accepted, which are accepted by all the business terms. These rules are accepted by all the business entities for preparation of financial statements. Now let us assume that person in India wants to invest in a business in USA. Now, before investing, every person will look into the information about the financial statements and working condition of the company. In case if every business entity follows its own accounting procedure, or if every country has its own accounting principle, it becomes difficult for an individual to evaluate the performance of the business. To eliminate this disadvantage, GAAP was introduced. Generally accepted accounting principle had come into existence so that any person which is residing in India, Pakistan, Nepal, USA, whatever it is, when the accounting information is prepared based on the rules which is accepted globally, it helps us to understand and brings the consistency and uniformity. So here the concept here the GAAP ensures, the purpose of GAAP is only to ensure that the information is transparent and consistent from organization to organization and from one accounting period to another accounting period. So in simple terms, GAAP is nothing but some guidelines and some rules for preparing the financial statements. So, generally accepted accounting principles are some set of accounting rules, standards, and procedures which is given by a board that is known as Financial Accounting Standard Boards. These rules are issued by Financial Accounting Standard Boards. Here, their main aim is to improve clarity, consistency, and comparability of financial information and govern the world of accounting according to the general rules and guidelines. and to bring the financial information as complete, consistent, and comparable. Okay, now we understood that these principles and concepts help companies to report transactions correct, accurate, and timely. And if every business has its own independent system of recording transactions, summarizing, and preparing financial statements, that could lead to some confusions and discrepancies, and may also lead to some fraud in the financial management. So, to overcome this, accounting bodies used a universally agreed upon set, which is known as generally accepted accounting principles. And these principles consist of some concepts, ideas, and assumptions and conditions on which the accounting of the recording of financial transaction is dependent. So we have few of these concepts like business entity concept, monetary concept, time period concept, matching principle concept, historical concept, going concern concept, full disclosure principle, revenue recognition principle, materiality principle, conservatism. These principles let us study one by one and understand how this principle is to be helpful in recording transactions. Business entity concept. So, in this concept, assumes that business has distinct, means separate entity existence from its owner. It is always treated that business and the owner have two separate legal existence. So if a person is running business, it does not mean that business and the person are one. It only means that business and the owners are considered as two separate entities. The separate entity concepts, this concept states that we should record personal and business transaction separately. Now if we take an example, as a owner, if he is contributing money, brings in money towards the business, it is treated as capital, and capital is recorded as liability to the owner. It is recorded as liability in balance sheet. And if a person takes money from the business for his personal use, then it is considered as drawings, and there is reduction in capital and reduction in liability of business because he has withdrawn some money. So it's always treated that business and the owner are have two separate existence, legal existence. Not record our personal transactions of owner into the books of business unless it is involved with some inflow or outflow related to business funds. So in this concept, it only means that business and owner are two separate entities. So next one we have money measurement concept. As while we were studying the process of accounting, first one, identification of accounting, we clearly studied there business records only those transactions which are related to business and are expressed in monetary terms, which has money value. Here this concept speaks about the same. It states that business should only record accounting transactions which are expressed in terms of money. These focus on transactions like quantitative, which are expressed in terms of money and are quantitative information like sale, purchase, rent, salary. Here, it ignores the transaction which cannot be expressed in monetary value, like we can say appointment of managers, hiring of new employees. Though they're adding value to the business, there are some internal changes in the business, but it cannot be expressed in monetary value. So it ignores the qualitative information and only transactions, only the concepts, information which are related to business and which are expressed in money value are recorded in the business. And also everything is recorded in monetary values in rupees and paise irrespective of unit. Like in case if a business has a building with 10 rooms or an land with 10 acres, we don't write it in units, acres, or rooms. We write it in quantity, in the value of money: 10 crores, 1 lakh, 2 lakh. So everything is expressed in terms of money. And here we have one limitation, that changes in price, the value of money does not remain the same. Whatever building you have bought today, you have purchased today, it is highly impossible that the price tomorrow or the price after 6 months or 1 year will not be same. It will be different. So this concept ignores the time value of money, because as and when the transaction is occurred, it is recorded on the same value. Here we can see that example that a CEO is delivers lectures to the employee. Maybe he's training the employees based on the new upgradation, helps in completing the current projects in time. These all are adding value to the business but cannot be recorded in the books of account. Here we can see purchase a land of rupees 10 lakh. Yes, it has some monetary value. This is recorded in the books of account and this cannot be recorded. So next we have is going concern concept. Under this concept assumes that business will continue its operation for long period of time and will not stop or liquidate its business in the near future. Here, this concept states that a business is in the position to carry out its daily operations and has capital and raw materials to carry out the manufacturing or production. The business is in position to pay off all the debts. And also, because of going concern concept, we also assume that there is good demand for goods and of the products and services which are offered by the company. Here this concept only assumes that business will continue its operations for long period of time and will not liquidate its operations in the near future. Next one we have is accounting period concept. In this concept, it states about the time period of which the activities have to be taken place in the and at the end of which the financial statements have to be presented by the business. It's nothing but a business calendar, the calendar of a company to follow, and at the end of which the business has to present its financial statements. So here we see that accounting period refers to the time span at the end of which financial statements are to be presented. Our financial statements of an enterprise are to be prepared. To know why are these financial statements are prepared? To know the profit earned and loss incurred in that particular period, and to understand the assets and liabilities at the end of the period. So these statements are prepared regularly after 1 year to year, with the time gap of 1 year to year, and are made available to various users of accounting. So here let us take an example that business this ABC company limited starts recording its transactions from 1st of January. In a 12-month period, that is at the end of December, 31st December, it has to present its financial statements recording all the transactions which it took place between January to December. So this is the accounting period. This was the time span of the accounting period of the particular business. So this accounting period concept helps in presenting information to all the users timely, and it helps in comparing performances from year to year. It's useful for the various investors and various other users to understand the financial trends of the business. Here we see that from 1st January to 31st December, this 12-month period is the accounting period. So next one is cost concept. Under this concept states that an asset is to be recorded at its purchase price, including all the cost incurred until that asset is ready to use, like transportation cost, installation cost, etc. Now, let us here understand with an example. Let us assume that Mr. A had bought a new machinery for his factory site. Now, let us assume that 5 lakh is the purchase price, on which he incurred transportation cost of rupees 5,000 to bring it at a factory site. Now it is bought at factory site. Now we have to do installation. For installation is spent rupees 7,000. Now totally he spent 5 lakh plus 5,000 plus 7,000. Here, to make that machine ready to use, he incurred 5,12,000. So under cost concept, it means that all these transactions must be recorded in the books of account, including purchase price, transportation, installation, until that asset is ready to use. Whatever cost incurred, all such costs are to be recorded. Here it means that this is historical in nature, which which has been paid on the date of acquisition, same is recorded, and we don't change it year after year. So like we can see, purchase price will remain same, but market value will differ. Something which we have bought today will not be same tomorrow, so we record it. This is known as historical. It is historical in nature. This cost concept principle is historical in nature. It does not consider inflation. Here the main purpose is to identify the original value of an asset. Next one we have is dual aspect concept. This concept states that for every transaction there are two sides, two-fold effect, and must be recorded on the two sides. So here it means that to receive something, we have to give something. To receive a benefit, we have to give something. Now for here, let us take an example. Purchase machinery for cash for rupees 10,000. Now you see here, there are two things come into effect. One is machinery, right? And another one is cash. Here, two things come into effect, machinery and cash. This means that you bought a machinery, which means there is increase in stock, right? Increase in your asset. And you bought it for cash, which means there is decrease in cash in the business. So it affects the two accounts. So this is known as duality concept, duality principle. There are two concepts, that is every transaction has two concepts, that is debit and credit, and it has two-fold effect and must be recorded into two sides. And there's a fundamental formula, that is asset is equal to liabilities plus capital. So this formula is registered in balance sheet, where all our total assets are equal to our liabilities of the firm and the capital. So dual aspect is also known as duality principle. So this was it for the class. Our remaining concepts we will be studying in our next video. Whatever doubt if you are facing in the concepts we have studied today, please go forward and put it into comments. We will solve them at earliest. Until then, signing off. Happy learning.